Tonight we're looking at investors. So we've got an interesting group of investors. The way it works is that they've got 3 minutes to kind of explain what it is they do, who they are, why they're doing it. And then after that, we'll get them to sit down and then we'll pepper them with really, really hard questions. So, the first speaker tonight, it's going to be Victor. Over to you. Thank you.
Thank you very much for this opportunity. I'm really elated to be here. I met some of you, but look forward to meet more of you. Thank you for inviting me to this occasion, Andrew. I really appreciate it. I guess a bit about me and Sapien Ventures. I'm, I guess, what they call a serial founder. I started my first company at age 23, a year and a half out of university, after working with a large corporation, and I thought I could do some of what they do. I was very young and very naive and didn't know what I was up for. But was able to pursue my dreams across 12 countries over 15 years, and worked with some pretty large corporations. I got acquired into IBM at a point in my career, and ran some lines of business for them in enterprise data management and capital markets. So I guess I was working with technology in financial services before the term FinTech was even coined. And when I came back to Australia with IBM, I was there for about a year, and I decided to found my next venture, online marketplace, and took that to Silicon Valley. Stayed there for about 3 years, built up what I consider an amazing network of people, and mentors and investors to meet. And we came up with this idea that a lot of people who are in consulting and professional services also happen to be technology angel or corporate investors, and there's quite a network for us to dwell on, some 6,000 of them actually in our network. So that was really the genesis behind Sapien Ventures. And so a group of us came together. We saw an opportunity in the Australian market, and also I wanted to be back home in Australia, or at least spending more time in Australia. And also I think there's a great opportunity to bring a lot of what has worked really well in Silicon Valley back to home and bottle a bit of the Silicon Valley know-how and experience to apply to and share with entrepreneurs like all of you. So I personally have benefited a lot from my time over there, and I learned to have a lot bigger vision, a lot bigger dreams, think a lot bigger, and look at things from a very, very different perspective. And I'm very open and happy to share that with folks back home. And when Sapien Ventures was founded about a year ago, we decided that Australia is a really interesting place, but it is a very small market. So for Australian technology ventures to really thrive on the global stage, one has to have a global outlook from day one. So it was really paramount for us to have that global presence and mindset from day one. So we started with a Sydney office and a Silicon Valley office concurrently, and now we have a year later office in Melbourne and also in Shanghai, China. So we recently onboarded what we consider a sister fund in Shanghai, and we are very focused on FinTech, online marketplaces, enterprise B2B software. We believe that in these areas you really need to tap into the right expertise and the right channels and the right markets, ultimately, to solve big enough problems in the right markets. And for that, our game plan is to bring Silicon Valley know-how and experience to apply to Australian tech companies, and then look for strategic market entry or exit opportunities in either North America or Greater China. So that's really Sapien Ventures in a nutshell. We're really pleased to be here, and really pleased that we've made our first investment in Hatching, and hopefully many more to come. Thank you very much.
Ben Armstrong's our next speaker from Telstra Ventures. Come on out and tell us about life at Telstra Ventures, please, Ben. Would you welcome Ben? Thank you.
All right, so I'll be brief. I'll make up some time for us here. My background isn't half as interesting as Victor's or some of the other speakers here. There is a failed startup in the past that you can ask me about later. And I was one of the people who put the business case together to actually establish Telstra Ventures, so I know a little bit about setting up a venture capital fund as well. But just briefly on Telstra Ventures and what we do. We're probably the least relevant to most of you in the audience tonight because we do later stage. So we've invested about $250 million across 34 countries, mainly in the US, Australia and Asia. We've got 6 exits, including companies like Box and Elastica. And what we have to do as a corporate venture capital organisation is focus on businesses that have some strategic relevance to Telstra. So this limits the whole universe of opportunities that we can explore, but it does mean that we can bring to bear a lot of Telstra's channels, a lot of Telstra's technology for companies to invest in, and that's what we seek to do. So the KPIs that are put on us aren't just financial return for Telstra from the exiting investments, but they're also, what business can Telstra drive through partnering with companies in the FinTech space, for example. So just briefly on FinTech, I mean, I'm personally very passionate about FinTech, but the kind of assets that Telstra thinks it has in this space include relationships with major banks. 3 of the 4 major banks in Australia are all significant customers. We've got a network in Asia Pacific that's a very high-speed network that connects a lot of exchanges between Singapore and Australia, for example. And we've actually made 4 investments that I would say are related to FinTech and/or FinTech investments. But perhaps I'll leave it there, and I'm really keen to hear questions from the audience. Thank you.
Yeah, so what we'll do is we'll have the next 2 speakers and then we'll have time to ask lots and lots of questions and get their stories. Andrey, would you come out and tell us a bit about Follow the Seed?
So, very quickly about myself. I've been an entrepreneur since I was 19, and over time I've built about 15, or started building about 15 of my companies, crashed and burned the first 7 or 8, and did slightly better later on, and then basically used the money to invest in other companies, and I've been doing it for about 11 years as my full-time job, backed about 60 or so startups, and Follow the Seed is basically my recent startup, but it's also a venture fund. So what is Follow the Seed? When we look at the venture capital industry, so VC's job is basically to fund the disruptors. And generally, this is the way disruption happens. The thing is that over the last 40 years, the VC model itself hasn't changed by a single bit. So the same way Steve Jobs was pitching Apple back in the 70s, people pitch their startups today. Nothing changed. Like, the only thing that changed is now using PowerPoints instead of slides or whatever they used back then. And we're here to change this. And we're doing it by introducing algorithmic approach to venture capital. So we've developed our own algorithms, and these algorithms help us screen through the noise. We don't make the investment decisions, but they make our lives as fund manager a whole lot of easier. So they basically screen about 99% of all the noise that otherwise would be wasting this company's time and our time without the algorithm. Now, what it does is essentially it enables us to democratize access to capital, because the algorithms are completely objective. They're not biased. They don't care what language you speak, what's the color of your skin, where do you live, where did you study, if you studied. The only thing they care about is about your execution and how well did you build your product, and most importantly, how your users interact with your product. So basically, how does it work? It's all fully automated. Any company that wants to pitch us, all they need to do is basically go to followtheseed.vc. They can click on the button, download the SDK. It takes I don't know, maybe 15 seconds to do it, and then they just embed it into their app, game, websites, whatever it is. And it takes about 3 weeks worth of data collection before our algorithm actually gives them a red fence score. If this score is above a certain threshold, we'll actually call you, so you don't need to pick up the phone, just sit by the phone. We also focus on a very particular area in terms of where do we invest, what's our sweet spot. So there are quite a lot of seed investors, writing checks between a couple $100,000 or sometimes a couple tens of thousands of grand, like maybe up to 1 million. And there are a bunch of Series A investors and above that writing $3 to $5 to $7 million checks. We identified, and there's quite a bit of a gap in between. So basically, we focus on about 0.5 to $2 million per company, which helps company that did raise seed funding or just basically bootstrapped all the way to the product, have some usage. Our algorithm doesn't require tens of millions of users, and we can assess a company with like as little as 1,000 users, basically. And this is the area we're playing in. Our team is quite international, and we actually cover Israel, US, China, and Australia in our fund. And basically, each one of us sits on a different continent. And between the four of us, I think we've funded probably well north of 100 companies, and had a lot of failures, first of all, but we had also some successes like M&As, IPOs, and stuff like this. Yeah, that's us. Thank you very much.
So I met Daniel Lavecky a few months ago. It's an interesting story, and I think it's a story that we are lacking quite a lot in Australia. So I'm pleased that Daniel's here, and he's going to tell you the story rather than me, although I recommend him.
Hi everyone, I'm Daniel. So a little bit about me. I started a FinTech company in 2000. I did a discounted cash flow as an intern at Commonwealth Bank. And I did a discounted cash flow and realised that my life was worth more than $500,000 at a net present value based on the salary I was on. So I decided I'm going to start selling technology. So I made a payment gateway and started to make wholesale technology to banks and hustled my way to selling to a bank here in Australia, convincing them beg, borrow and steal to try and use our technology. Expanded into Asia, and through, I wanted to show one picture of the beginning. So this was in November of 2000 when we got our first $500,000 angel round from our investors. It's myself on the right, my brother, and my wife on the right of my brother. So it was a family affair, and we started off at the Australian Technology Park. Went through a lot of adventures, and got to 2005. This was celebrating our 5th year, which statistically most venture-funded companies fail. So I'm Sydney Harbour with the team. That's our CTO, the Indian gentleman on the right who had studied at AI. And then in 2015, got to fly my first private jet. And so that was a wonderful adventure that we just did. And what it shows is that with hard work, with dedication, with commitment, with going through unbelievable odds, you can achieve wonderful success through entrepreneurialism. And so I'm hoping as a venture capitalist to support the people who want to do that. So I wanted to give a few ideas about what we're looking for. And the first thing that I'm looking for is free. I like to give away things for free. The only way that we competed with banks, with other competitors to the banks, is that we gave our technology away for free, and we charged them at the end of the month. We wanted to have access instead of ownership. So with ownership, Uber doesn't own a taxi in the world, yet it has access to them around the world. I really like ad valorem fees, percentages rather than transaction fees. I don't like flat fees. And a founder with domain knowledge. So if someone's just starting up something, hasn't worked for a few years in it, I don't know if they're really going to understand the nuances about it. I know that I lived, breathed, and sometimes cried about some of the results in the company, and as a result, I knew that that makes all the difference. You have to be international in nature. I was so committed to seeing the success of pure commerce. It was like an Olympic dream to go to Rio and then win a gold and maybe even set a world record. I gave up so much of my life, friends, holidays, health in some areas, because I believed in a dream. I moved to Singapore with my family for 10 years in order to expand internationally. So just like you commented before, expansion internationally is an absolute must because Australia unfortunately doesn't have, whilst it has wonderful beaches and sun and clean air and good food, the market doesn't drive global expansion. So we're also looking for recurring revenues and annuity streams and barriers to exit rather than barriers to entry. So we always thought about fanatical customer service, and not quite dissimilar to what you just said in your speech, in fanatical raving customers. We thought it was fanatical customer service because for every bank that we signed up around the world, which included some of the world's largest banks like Citibank, Korean Exchange Bank, Tyro here in Australia, there were 10,000 or 100,000 customers that provided, that were our potential customers. So the things that we're seeing a lot of is blockchain opportunities. We're looking at wholesale services to establish players. I don't think disrupting the banks, destroying the banks is actually a good thing or necessary. I believe that if you can do it in a cooperative way, there is just as much money to be made and probably with less capital needing to be deployed to achieve the result. And what would I like for you to learn about is if you're looking for investment, you've really got to show your passion. You've really got to be aggressive in client acquisition, and you've got to show your hunger. Absolute Olympic dreams are the only way to succeed and to live your dreams. Thank you.
So let's get the speakers up. We'll have them sit down here and we'll pepper them with some questions. And I get to ask the first question though, okay? Follow the seed. The amount of capital you said you're putting in was 0.5 to 2. Can I ask you, today and in FinTech, is that following the seed or has that actually become seed? We've seen some companies over the last few weeks even raising 1.5 as their first pre-MVP round. Is it different in FinTech? Things got bigger. What's the trend you're seeing? Daniel, could you share that microphone, please?
Yeah, sure. So basically, the definition of pre-seed, seed, angel, and Series A is kind of all over the place, and it's highly dependent on the territory as well. So it actually doesn't matter that much, because in some cases, even though we follow the seed, we're still the first investor in the company, because the company decided to bootstrap, which I highly encourage every company to do. And I always say that the best advice I can give them is not to raise money ever, because investors are essentially a headache, and if you can get along without them, that's the best strategy. And so essentially what we're doing is that we're helping the company that does require this extra bit of capital to move from, hey, we finished product development, we have some usage, but shit, we didn't think that we need actually money for marketing and stuff like this. And of course, the development, both in terms of time and capital, took us at least twice as much. So we're actually out of money, but we have a product and we can't raise Series A because our numbers are shit. So this is where we come.
Okay, thank you. So, question. We had a question over here.
Hi, my name's Lorraine. This might be a bit of a broad question, but I was just wondering, what do you think are sort of the customer pain points in FinTech that you're looking to invest in? I was just wondering if you've got some seeds that people you're particularly targeting and what problems they might be solving.
So I love the idea of cutting someone's margin out as my profit. That's from Amazon, and that's something that I've believed in for a long time. In servicing our customers, we always try to do more and deliver more at a far cheaper price. And through technology, it's very easy to achieve that. So examples in my area, like foreign exchange, Oz4X was revolutionary when it first came out, because normally a bank was charging 200 basis points and Oz4X came along at 20 basis points. So I think cutting out fees and bringing it closer to wholesale markets is an area that's very interesting to consumers, because they're always looking to save money. And if you can do it by delivering value-added services on top of that, then you have a sustainable business into the long term.
I have to say I found myself quite in agreement with that. Also, in addition, from our perspective, we really like the idea of technology serving as a disintermediator. By that I mean, we're quite focused on online marketplaces or digital marketplaces in general, particularly in financial services, because we feel that a big pain point for a lot of customers of financial services is that they're not being serviced in the way that they could be serviced in the 21st century. In 2016, when you can order a pizza and most other things off the internet, off your smartphone, and have it delivered to wherever you are through GPS and whatever, banking financial services hasn't caught up to that. And we like to see a future where one day I can order my mortgage or request a mortgage and have it approved on my handset in a matter of minutes. I think that's the technology is already there to allow that to happen. That would be a phenomenal customer experience improvement, and that is the role of technology that we see that could fundamentally disruptively improve the customer experience. And these are the ventures that we're really interested in.
Sure. So we seem to be talking a lot about consumer. I mean, there's other players in FinTech as well. So, I mean, yes, you can look at consumers, you can look at small businesses as financial services players, you can look at the customers, sorry, or you can look at the existing financial services providers and their potential customers waiting for a new way of doing things as well. And I just agree that one of the problems, if you think about it, is a lot of financial services are regulated by a country, and people tend to think of just an opportunity in that country. And I think the really disruptive stuff that's been done in FinTech is global in nature. I mean, sure, they've got to deal with those regulatory barriers in each of those countries, but as a consumer, as a business, you want to be able to deal with the world on your terms wherever they are. And I think those businesses who can address a global market will be able to scale and get to a substantial market share.
My name is Jessica. I'm actually a journalist from the press gallery, and my question is for Ben. Interesting, like you're talking about your relationships with banks and all your global network. But how to address it? Early 2015, I talked to one of the Telstra directors, and also at that time, Martin was still communication minister. I said, I think Telstra also needs to start looking at, I didn't use the word FinTech, but I said like online communication and financial services. And I mentioned the WeChat. I'm not sure how many Australian people might know about this. But maybe I'm a little bit rude, but the reaction was very ignorant. They said, okay, that's Chinese Twitter. It's not. And Telstra, I literally told one of your advisors, I said, Telstra needs to start to do this. Otherwise, the export Australian financial services to global market, for example, to China, is a dream. And now, almost 2 years passed, we have seen like Alipay or WeChat being used very actively, locally, and also by the startups actually.
You've got to wait for the question.
Oh, yeah. The data also
it's very soon.
Okay. Data also shows that the startup has a very limited lifetime, like 18 months, I think, something like that. How Telstra, like a big company, couldn't catch opportunity, can actually tell us that we can do it right now? Because I really have done something.
I was going to say, it's a very hard question. I mean, you're asking about I'm not speaking here on behalf of all of Telstra, I'm just in Telstra Ventures. And we're always agitating for change. We're always looking out at the market, seeing these great companies doing new things, solving problems in different ways. We try to bring back and say, have you seen this? What about look at using this, partnering with this company, trying to deal with the market in a new way. I mean, WeChat's been very successful in China. I don't think anyone's had the same success even when they've tried to copy the app in the US or Australia. It's probably unique to that market, but it's a long way of saying we are looking at all that innovation, but it's hard to change a big company through minority investing.
Sorry, if I can just like to provide some a bit of more context. I think as Ben mentioned, that basically Telstra Ventures is probably the least relevant venture fund for this audience, but Telstra does some other things which are purely done for the sake of the ecosystem. And one of the examples would be UOD. And that's an accelerator that is completely funded by Telstra. And basically, there would be absolutely no financial return to Telstra from this accelerator. Like even if there would be some phenomenal success out of it, because in terms of Telstra's balance sheet, it's just not going to move the needle just a tiny bit. So again, there are basically different parts of the companies, of like the big companies that are supposed to serve different purposes. And I can point you out to like basically all the big four banks and probably all the insurance companies in Australia, everyone saying, hey, innovation, 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 and basically when you come to them and ask like, what innovation actually is we're going to take 50 million bucks, chuck it in the fund, and yes, we're innovative bank or insurance company or whatever it is. So this is how it actually works. So, Telstra, like it's a big, big company, and for them to move like a tiny bit, it's difficult, but I think of it as an entrepreneur. It actually provides me with a hell lot of opportunities to disrupt them a little bit, and then, basically, go for a home run.
Hi, I'm Ben. We just have like a few questions. So pretty much like the big venture or seed capital funds willing to provide like additional support apart from like money? For example, like an AFSL license to those who actually don't really have experience.
So are they
open to like providing other kind of assistances rather than like monetary? So for example, like with the I guess some of the feedback we've got are like some venture funds aren't really wanting to provide the AFSL license because they're like, is there really a need for like our specific fund to provide that? They don't expect us, the individuals, to already get that before kind of joining into the like accelerator.
So you're in a FinTech, are you?
Yeah, that's correct.
And you need a license? So
we definitely like we need one to operate. So we're shopping for one around. Like we've been discussing with a few people, and then like we can lease it, we can partner up, but like the best case scenario is like we join accelerator and they help us get the FSL license as well as the people on board who can help us.
And have you heard of the Innovation Hub?
Yeah.
At ASIC, have you used them?
So we're in preparation to do that, but we have applied, and some of the feedback we have gotten was like, should this specific fund of names, are we really looking forward to providing FSL license or support for FinTech startups? Yeah.
So providing a license, that's an interesting one. So this morning, as it happens, I sit on ASIC's Digital Finance Advisory Committee, which is an accident. But the message they want to get out, and they said this morning, we were looking at the statistics. FinTechs that go to ASIC using the Innovation Hub get their license more quickly on average than those who just go through the standard process. ASIC is really, really keen to hear from FinTechs and sit down and talk in an informal way to help you through that process. So it's not just an ad, the stats actually back that up. And a couple of the companies that we know here at the Hub are going through that process, and it's informal and it's hopefully very helpful. If not, you can always come back and talk to me. So are you guys going to provide licenses for these poor FinTechs? Because it's pretty hard to get one.
Any of our investments, I think one of the values that we bring at DB Capital is that we're going to provide everything and anything to get a fantastic growth rate for your company. And what that means is using our battle scars that came along the way. And those battle scars serve a very key purpose, which is to help the organizations that we invest in to grow. So I personally believe that rather than getting it from someone else, my personal belief would be figuring out how to get it yourself and leveraging off organizations within the government like the Innovations Lab to get you through as quickly as possible. There's a couple of things to do that. It shows that you're committed to the success of the organisation, and also it gives you independence. If you're tied to one organisation that's provided the financial services license to you, you're going to be with them for a very long time, and you lose that independence. So as you grow, your needs are going to change, your focus is going to change, and your strategies are going to change. So you want to be able to have that independence to adapt and be nimble. And as I always thought, hustle while you work.
As investors though, would you prefer that your startups went and became authorised under someone else's licence, very quick, relatively cheap, and it's the way most fintechs go, so you don't need to get your own licence, you can go and find someone who has a relevant licence and then operate underneath them. That gets into the market, that gets them testing their product. Would you prefer they did it that way, or that they went to the start and got their full licence themselves? Victor?
So just partly to answer your specific question, but also I want to build on that and talk about a more holistic value add from your investors that you should be looking for. So on the subject of AFSL, I personally don't see that as a big problem. I mean, we get pitched by fintechs every day. Most of them are resourceful enough to figure out a way to leverage in some way someone else's until they either get funded or have the cash flow or have the means to acquire themselves. And obviously not all AFSLs are the same, so it depends on your business. We've never come across anyone where they were really confounded by not able to get past that obstacle. The point I wanted to make, and again building on Daniel's point, which I think is really important, and it's also a driving philosophy for us, is that we don't ever want to be a pure passive financial investor. We look in certainly early stage venture capital, we have this philosophy that it's not all, or perhaps it's not even most about the capital. It's more about battle scars, the value add, the resources, the connections, the relationships to the right institutions, being able to open the doors. So to the point that both at Hashing and several other companies that we recently offered term sheets and finalizing investments in right now, we have gotten on board with them in an advisory capacity, absolutely taking them into C-suite connections that we have at some of the largest financial institutions across Australia to help them generate deals, and in the process also monitoring how they're executing, how they hustle, and in that process evaluate whether this is a team worthy or not to back. So to that extent, from an entrepreneur's perspective, I strongly encourage you and perhaps all of you to look for those investors that are willing to do that with you, and when they see enough evidence that you guys are able to execute, then come in with the money to just scale what has already proven to be working. So from our perspective, that is a much more risk mitigated way. That is far more likely to lead to a positive upside, and that is the only way we invest.
Now, you told me you're a fintech.
Yeah.
And you're looking for a license. There's 4 investors down the other end. Can we hear your elevator pitch?
Oh, okay. Yeah.
The answer's always yes, isn't it?
Yeah, let's do this.
All right, let's hear an elevator pitch.
So, hi everyone, I'm Ben. So, I'm from a company called Fractal Wealth Management, and what we do is we do automated wealth management. So, what makes us, I guess, different from the others competing on the market is that we offer very low fees. In comparison to StockSpot, I think they recently changed their fees to like $55 from $77. Plus a certain percentage per month. We actually offer a flat rate plus a percentage, so we offer $15 plus 0.5% for our passive, and another and 15 plus 1.25 for our active. So the reason why we're different is that we offer active investing. So we believe that it has for investing you have to have a holistic approach to things, and also investing shouldn't be too hard. So with us, you can make it it's in a simple platform, and everything is breezy quick. So you just get in, do some questions, and put some money in, and it will automatically invest for you without you even doing anything. Yeah, that's it.
Well done, eh? Give him a clap. That's great. So, what do you think of that pitch? Are you investing?
No.
I told you. Didn't I say earlier on? He'll tell you exactly what he thinks. Sugar it for us. Come on. Why not?
First of all, you need to polish your pitch, man. And you either think of a use case and just basically tell the story from one of your prospective customers, because essentially you're getting into an area which is super crowded and saying that your main differentiator is the fees. How long do you think it's going to last? You need to be better on either the product, or on your experience, or on your marketing, or whatever it is. But basically, one of the things that we do is that we kind of extract the data which comes from your users using your product. And this is the only thing we analyze. We don't care what fees you have. The only thing we care about is what your users not just think about you, but actually the way they use your product. So it needs
to be fair, though, you're pre-seed at the moment, yeah?
Yeah.
Yeah. So I think the feedback is you can do a lot better. Telstra's feedback is what?
Well, I mean, I would say you're a bit early for Telstra Ventures, and I direct you at Murray.
Now you know why they invested in Murray.
But I mean, yeah, I think a lot of what was said before is true, but I worry more about the space that you're trying to get in, and it's really, to me, that whole wealth management space, it's got a few big companies that are really trying to exit at the moment, and if you look at them, they're pretty undifferentiated. I mean, what's the value add besides pointing you into ETFs and maybe doing it automatically for you? I mean, I can do that myself if I'm motivated to do it probably cheaper than some of these platforms. What I think they get interesting is where they do things like tax loss harvesting and somehow taking the personal tax circumstances into account. So I'd sort of encourage you to look at the differential, why you think this could be really big in 5 years' time and it's going to get you $1 billion exit. And what is it that you have that others don't?
It's really hard to get up when you know you're about to do an elevator pitch and then get very real feedback. And I'm sure there's 1,000 things going through your head that would answer what they're saying. So you can meet with them afterwards. We'll give you a free meeting with each of the four. Let's have another question.
Thanks. So I work in a risk business and I'm very risk conscious. So considering you guys have accumulated quite valuable experience through crush and burn in very early stages of your FinTech venture, I just wanted to, I think there's a lot of dollar value in that experience, and I want to pick your brain as in, apart from the number one reason why FinTech died, which is cash flow. So apart from poor financial management, what are the other common risk alerts or warning signs that you see when when you're pitched, which is less than obvious?
What are the common risks for startups?
So when you're pitched by a FinTech,
yes.
What makes your heart jump? What makes you think this looks fantastic, but there might be enormous risk behind it?
Mm-hmm. Look, I think any startup is going to be incredibly risky. As a venture capitalist, I know that 7 out of the 10 investments that we make are either going to fail or be zombies. Only 3 will survive. And so I always think about the things that I personally experienced as CEO of Pure Commerce, those I'm using as a model in order to assess what will survive. So I mentioned that in my speech before, recurring revenue is tremendous. I grew up in a clothing manufacturing family. And so every month we restarted the shop clock, if you could, to think we need to make mortgage payments every month. And so as I grew up, that was a very stressful environment for our family, where if we didn't make, my parents, didn't make tracksuit sales, that was a very stressful environment. And so what occurs to me is that a recurring revenue stream is critical to protect against some of the downsides. So that's one thing. Long-term contracts, barriers to exit, annuity streams, not earning stock, being an agent of some sort. Uber is an agent of an enormous amount of taxis around the world. That, to me, are some of the checkboxes that we look at for our fund to be able to justify investment in an organisation to help them to grow.
Yeah, so just to make sure I understand the question, I think there's two parts to it. One is about what are some of the potential risks that we come across or see, and I think the second part is that may be less obvious or that perhaps are not immediately aware to the entrepreneur, right? So in FinTech, I think, given that it is, well, financial services, given that it's one of the most intermediated professions or industries on the planet, there are very, very entrenched distribution relationships and channels. So as a startup, when you don't have much resources, or hardly any resources, or barely any capital, to come up against very entrenched relationships, that is inherently very, very hard. And we think that any startups that haven't figured out how to tap into an entrenched distribution channel very quickly are going to die. So that's one of the tests that we look for, is what experience, what relationships, and I don't mean necessarily personal relationships, but that would help. But if you have worked in industries, worked in particular organizations where you have some secret sauce on how to tap into distribution, personally I think you can have a mediocre product, but it's just far better distributed than every other product out there, and you have commercial success. So not everything comes down to shared technology. In fact, a lot of things don't come down to shared technology in FinTech, in our perspective. It comes down to building a lot of those barriers to exit. I fully agree with that, but distribution is key, and that's quite frequently not obvious to the founders that teach us.
So I guess to replace the incumbents, one thing is to look at the nature of the relationship and how easily you can commoditize that relationship, so to replace the existing ones.
Not commoditizing, but tap into those relationships, adding value to that relationship.
Yeah, so I actually have a quite a specific view on FinTech in general, and I actually think that at least half of the startups that are claiming that they are in FinTech, they actually have nothing to do with Fin or Tech. Most of them are just basically traditional operations in a different marketing wrap-up. And that's the thing that generally concerns me, because for the starter, you need to be true to yourself in terms of identifying what vertical you're dealing with. And I see a lot of these FinTech startups, particularly in Australia, doing things that me and my friends have been doing 15 years ago. We just called it affiliate marketing. And it worked very well for us. So it could be a very profitable business, but there is absolutely no tech, and the fact that you handle dollars doesn't turn you into a financial operation either.
The guys have been very, very generous with your time. I hope you can hang around a little bit so we can do some networking with you. But would you thank the panel for giving us their time?